Multiples valuation is the simplest method of valuing a stock. It requires an analyst to assign values of far fewer inputs than the dividend discount model or the discounted free cash flow valuation model. The simplicity of multiples makes it intuitive and easy to implement. On the other hand, its simplicity also imposes restrictive assumptions that poorly match the complex realities affecting a stock's true value. A multiple is a ratio of a market value to a fundamental value of firm's performance. The most common example is a PE ratio, or price to earnings ratio. This is the market price per share of a company divided by its earnings per share. For example, if a stock is trading at $40 per share and its earnings per share is $2, then its PE ratio is $40 divided by $2 equals 20. This tells us that the market assigns a value of $20 for every dollar of earnings the company reports. Now let's talk about how we would use a PE ratio to value a company's stock. If company A's PE ratio is 20 and company B is in the same line of business as company A but smaller, then we would expect the market to value company B's smaller earnings per share the same as the PE ratio of company A. Suppose company B's earnings per share is 50 cents. Company B should be similar to company A in growth prospects and risk. We would expect that the market also would value company B's 50 cents in earnings per share at a rate of $20 per $1 of earnings. Therefore, company B's price should be 50 cents times 20 equals $10 per share. If company B's actual market price were $15, then we would conclude that it is currently overpriced based on the market's pricing of company A, and therefore either the market price of company B should fall and/or the market price of company A should rise. Notice the very big assumption we made, that company B is exactly like company A except in its size. This method of valuation does not provide a clear way to adjust our valuation of a company based on even the smallest differences from the reference company. To reduce the impact of company unique factors, it is common to take an average or median PE of all the firms in the same industry. Nevertheless, if the company being valued has unique factors not shared with the average firm in the industry, then we are still limited by this assumption that the company is just like the group of its peers. So the selection of what peer firms are comparable is the most important decision that an analyst has to make when using multiples to value a firm. These comparable firms are so important and frequently referenced that they are often called comps for short. Any ratio of a market value to a measure of fundamental performance is a multiple, not just PEs. Another common multiple is the enterprise value to earnings before interest, taxes, depreciation, and amortization, or EV to EBITDA. The market's enterprise value is the market capitalization, number of shares times price per share, minus its cash plus its debt. As with the PE, multiply a peer or peer average EV to EBITDA by the company's EBITDA. This gives us our estimate of the intrinsic enterprise value. Then calculate the share price as we did when we estimated the enterprise value in a DCF. Add cash, subtract debt, and divide by number of shares. We may prefer using enterprise value to EBITDA rather than PE for several reasons. First, EV to EBITDA is insensitive to debt usage, which allows us to use peers with different capital structure, that is, how much debt they use versus equity. Second, EBITDA is closer to operating cash flow than earnings, which are net of large non-cash expenses such as depreciation. Third, the firm we wish to value or one of its peers may have negative earnings, in which case the PE is meaningless. However, it is more likely that a firm will have positive EBITDA, which means the enterprise value to EBITDA can be used. Another multiple that allows us to value a company with losses or use peers with losses is the price to sales ratio. By choosing the top line of the income statement, we have the best chance at being able to calculate a meaningful multiple. Price to sales is particularly useful for valuing companies that have yet to turn a profit.